Hello everyone, I am Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr. SNS College of Arts and Science. In this video, we are going to see about credit risk management. So, what is credit risk management? So, credit risk is a crucial function for banks and financial institutions. This focuses on managing the risk that borrower will default on the financial obligation. So, when a borrower, if he does not pay and if he does not meet its debt obligations, whether it is in interest or principal payment, it is known as credit risk. So, effective credit risk management helps institutions to minimize potential losses while ensuring profitability and maintaining a healthy portfolio. So, there are different types of credit risk. So, that is default risk, concentration risk, counterparty risk. So, default risk, the risk that a borrower will be unable to meet their debt obligations. Concentration risk, the risk of a loss due to exposure of significant portion of the credit portfolio to a single borrower, industry or region. Counterparty risk, it is risk that the other parties in a transactions, example in derivatives or trading, will default on their contractual obligations. So now coming to the key component of credit risk management. Credit assessment, credit scoring, a quantitative method used to assess the creditworthiness of a borrower by evaluating their financial conditions, credit history, and the ability to repay the loan. So qualitative analysis, that is assessing on financial factors such as management, quality, market position, and industry outlook, etc. So there are 5 C's of credit. Banker often evaluate borrowers based on 5 C's, that is their character, capacity, capital, collateral and conditions. Character, the borrower's reputation and credit story. Capacity, the borrower's ability to repay the loan, that is his income and cash flows. Capital, the borrower's net worth or equity in the project. Collateral, assets pledged as security for loan. Conditions, external factors such as economic conditions and industry trends. So before lending any loan, the bank will follow this 5 C's. Credit approval process, loan application. The borrower submits a formal application with all necessary documentation, that is his financial statement, collateral details, etc. So risk assessment, the banker credit analyst assess the borrower's creditworthiness, reviewing financial data, past borrowing behavior and market conditions. So he'll give risk grading system, assigning a risk rate the borrower based on their credit analyst. This helps determine the terms of the loan, that is interest rate, collateral requirements, etc. Credit approval, loans are approved based on internal policies and depending on the size of the loan may require approval from senior management on a credit committee. So credit monitoring, ongoing monitoring. Bank continuously monitor the financial health of a borrower and any changes in their ability to repay loan. Early warning signals, bank uses early warning indicators such as late payments, financial ratios or diverse changes in market conditions to identify potential loan problem. So portfolio preview, bank periodically review the overall credit portfolio to ensure it's aligned with the institution's risk and to assess secretarial or geographical concentration. Mitigation techniques, collateral management. Loan are often secured by collateral properties, that is equipments or financial securities, reducing the risk of loss in case of default. Convenient legal agreement in loan contracts that impose certain restrictions on borrowers, example maintaining certain financial ratios to protect their lending. Credit derivatives, financial instruments like credit default swaps can be used to transfer or hedge credit risk. Diversification, spreading risk exposure across different sectors, regions and borrowers to concentrate risk. So provisions and reserves, banks are required to set aside provisions for loans that are the risk of default. The amount of provisions depend on the classification of loan, that is standard, substandard, doubtful or loss. Non-performing assets, loans that are overdue by 90 days or more are called NPAs. bank must provision higher reserve for NPAs to cover potential losses. Regulatory frameworks like Base 3 set out guidelines for maintaining adequate capital reserves to absorb potential credit losses. So, recovery and resolution, loan restructuring. In case where borrower faces temporary financial difficulties, bank may restructure the loan terms, extend the repayment period, reduce interest rate to facilitate repayment. Collection and recovery. For defaulters loan, bank may indicate collection action which would involve legal proceedings, asset seizure, or selling the loan to a recovery agency. Write-off. If a loan is deemed uncollectible, it may be written off as losses through the bank, may still pursue recovery through legal or other means. Thank you.